Warren Buffett, you know the name, the Oracle of Omaha. He's arguably the greatest investor of all time, a legend who built a massive fortune by meticulously picking individual stocks. But here's the thing, and it's a real head-scratcher. For decades, this master stock picker has been telling basically everyone, including his own family, to do the complete opposite.
And that brings us to the big question we're digging into today. It's a paradox that ties so many investors in knots. Should you try to copy the focused, high-conviction strategy that made him a billionaire, or should you take his public advice and just buy the whole market?
And look, we're not talking about a small contradiction here. On one side, you have Buffett saying things like, diversification may protect wealth, but concentration builds it. But then on the other hand, he flat out told the founder of Vanguard, John Bogle, that a low-cost index fund is the most sensible equity investment for the great majority of investors. So what gives?
Okay, so to untangle this, we have to start with Buffett's most famous and maybe most misunderstood quote on this whole topic. The answer starts to come into focus right here.
Right. This is the quote. You've probably heard it from every hyper-confident investor who thinks they've found the next Amazon. But the part everyone seems to gloss over isn't the exciting second half of that sentence. It's the really humble, really important first half.
Let's be really clear about what Buffett means by ignorance. He's not calling anyone stupid. He's talking about a very, very specific skill, the ability to accurately predict the future of a business, almost with certainty. For him, it's an honest admission that most of us, well, we're working with incomplete information. We're operating under uncertainty. And for any investor who can just admit, hey, I don't know the future, diversification is what the academics call the only free lunch in finance. It keeps you from getting wiped out by one bad bet, and it lets you ride the growth of the whole economy. You know, as Buffett himself wrote way back in '93, by just owning that limitation and buying an index fund, the so-called know-nothing investor can actually beat most of the pros. So that brings us to that really seductive, really dangerous second half of the quote. It makes little sense if you know what you are doing. The problem, of course, is that almost all of us think we know what we're doing, even when we really, really don't.
And there's a whole field of study, behavioral finance, that tells us exactly why we fall into this trap. We get overconfident. We get what's called the illusion of knowledge, thinking one more research report is going to give us the edge. And we get hit with this huge survivorship bias. We look at the Forbes 400 list, see all the billionaires who made it all in one company and think, yeah, I can do that. What we don't see are the thousands, maybe millions, who tried the exact same thing and went broke. And the real-world result of this thinking can be absolutely brutal. I mean, take a look at this data from a real-life hedge fund. One year, it's the top-performing fund on the planet, up a staggering 122%, holding just 5 stocks. Amazing, right? But just 2 years before that, that same fund was down 77%. That's what concentration does. It's a roller coaster that can shoot you to the very top or drop you right to the bottom.
Okay, so that raises the obvious question. If putting all your eggs in one basket is so risky, how did Warren Buffett become one of the richest people on earth doing exactly that? Was it just pure skill? Dumb luck? Well, it turns out academics have actually figured this out.
When researchers really dug into decades and decades of Berkshire Hathaway's returns, they found it wasn't some kind of unknowable magic. His incredible outperformance, his alpha, it could pretty much be explained by a systematic, repeatable formula, with one huge catch. A groundbreaking paper from 2018 called Buffett's Alpha just laid it all out with hard data. It showed that Buffett systematically bought 3 types of stocks: cheap ones, high-quality ones, and low-risk, stable ones. These are well-known market factors. But, and this is the key, he had a secret weapon that you and I just don't have: cheap, stable leverage. The giant pile of cash from Berkshire's insurance companies, the float, acted like a massive amplifier, juicing the returns from these pretty safe strategies. So just think about that for a second. His edge wasn't just being smarter at picking stocks. It was building a corporate machine that gave him this enormous, permanent advantage that no regular person can ever replicate. He wasn't just playing the game better than everyone else, he was literally playing a different game. And you know, when you finally understand that structural advantage, the whole paradox we started with just disappears. Suddenly, his actions and his advice make perfect, logical sense.
This quote from an analysis of his track record just nails it. His career isn't a roadmap for you to follow. It's actually the ultimate proof for why you shouldn't try. I mean, if the greatest investor in history needed a massive, unfair advantage to win, what shot does a regular person have?
So what Buffett's really doing is laying out 2 paths. Path number 1 is for like 99.9% of us. It's to follow his advice,
Admit you're a know-nothing investor, in his words, and just buy a low-cost index fund. Path 2, trying to copy his actions, well, that's for the tiny handful of people who not only have his genius-level skill and discipline, but also have his unique access to a giant pile of cheap money.
And if you need one last piece of evidence, one final killer proof of what he truly believes is right for most people, just look at his own will. He has directed the person managing his wife's inheritance to put 90% of it into a very low-cost S&P 500 index fund. He is telling his own family to do what he says, not what he did.
Which really just leaves us with one last, very personal question. When you look at all the data, when you see all the behavioral traps we fall into, and when you understand the massive structural advantages that even Buffett needed to succeed, you have to ask yourself with total honesty, are you truly the exception?